Good morning, James. Thanks for joining me for our mid-year market review and update.
Thanks for having me, Luke.
So one of the interesting dynamics, we've seen Treasury yields actually move higher than corporate investment-grade corporate credit spreads and earnings yields on the S&P 500 for the first time in decades. You could almost say bonds are back in vogue. What's your take on what that means for markets?
Yeah, no doubt the bond market has had a horror last couple of years. Down in the order of 10%. The previous calendar year, as at the time, central banks globally had pushed monetary policy levels to a point where TINA was the only way to invest. There's no other asset, so equities were bought, credit was well supported. Now we've seen this pullback in bond yields, and it's a reset. And what bonds in itself are a resetting asset class. So we're back up to 4%, as you say, for a 10-year bond. If you look at the 3-year US Treasury, that's over 5%. You compare that to the S&P earnings yields, which is in the low 4s. It makes for quite a positive year and a good outcome to own bonds from here onwards.
And so I guess we've had quite a lot of conflicting data prints in the calendar year so far, which has been really challenging for a lot of market participants. In particular, we've seen sort of inflation started to slow in Australia, but some of the core measures have remained sticky. I think retail trade is sort of surprised to the upside. In the US, obviously GDP is looking quite positive, and new housing starts have been really strong. But then some of the more leading indicators have continued to sour on the flip side. So how do you read into some of those conflicting signals, and how do you sort of navigate this sort of environment?
Well, there's been a lot of signals and indicators that we look at very closely that historically have been really good indicators of recessionary outcomes. So when you think about leading indicators, yield curve inversion, University of Michigan surveys, they've all been historically accurate in saying that we're due for a slowdown. But what we have seen is resilience in the consumer. Household strength has been another surprise to the upside. So what's driving that is just pure demand and immigration levels to developed markets. You've got, as I said, the consumer in great health, and what's happening. Although we're seeing the increase in rates and monetary policy, wages at the moment are keeping up. Now, how does that look going forward? Well, at some point it will put a strain on corporates. And at some point that will end up, if the market turns out as we expect, in slower job growth and eventually job losses, which will slow the economy.
Yeah. So I think from some of the recent commentaries, the JCB view has been that rates are likely to remain higher for longer going forward. I'm just curious as to how that view compares to where the market's priced currently. I think the market has sort of continuously pushed out some of the rate cut expectations, now looking at cuts early next year. How does that sort of interplay with the JCB view?
So of the developed markets that we look at closely, it's actually only the US and Canada that currently have positive real rates. So everywhere else is still in a stimulatory environment. So the US Fed funds rate is up over 5. Canada's up close to that, and they're the only markets that are actually seeing their inflation rate falling below their cash rate, which is something that all markets need to really see slowing. Same can't be said for Australia, same can't be said for even New Zealand, same can't be said for Japan, and it's these markets that we expect to keep the higher for longer aspect of global rates markets. If we look at the Fed policy over the next 6 to 12 months and where we think that will end up, and even looking forward, there are conflicting views. Even if you go to the Fed themselves, so each quarter they put out what you call the dot plot. So they put their forecast out for where they expect the Fed funds rate to be in future years. The 2025 dot point, so in 2 years' time, the Fed governors, who are the experts in these fields and are setting this policy, they're anywhere from 2 3/8 up into 5 5/8. So the Fed's dot plots actually have a range of about 3%, which is quite a confusing signal to market participants. So it's really hard to have any confidence and clarity of where the Fed funds rate will end up in the next couple of years. At JCB, we believe that inflation is slowing. We have seen the peak. If you look at the US, they've gone from a 9% headline rate just over a year ago down to a 4% at the moment, and the way that the monthly inflation prints will drop out, we'll have 3 point something as a headline rate in the next month or so, which is very positive for markets going forward, and it's showing that the lag effects are taking hold. As far as further looking forward, the longer that interest rates do stay higher, we believe that the harder the landing will be. So at some point, and we've seen at the last meeting, the Fed did pause for the first time in 10 meetings, the most recent June meeting. The next couple of meetings in July and then September will be very interesting, but we'd expect to see the top of the Fed funds rate over the next 2 meetings.
And so when we do get to that point of rate cuts, it's likely then that the central banks will be forced to cut quite aggressively in that sort of hard landing scenario.
In the hard landing scenario, it definitely will be. It'll be, the first cut won't be 25 basis points, it'll be 100 basis points. With inflation where it is and with the job market so sticky though, going back to our earlier point, we still see the higher for longer for now mantra playing through. So we're not expecting any rate cuts in 2023. We'd expect some monetary policy easing come the first half of next year.
And so just expanding on that scenarios sort of topic, I know yourself and the team at JCB do some really good work in terms of thinking through the various potential scenarios and pathways that markets can take. Can you just give a bit of an update on how you're thinking through that sort of scenario analysis framework for the bond market looking forward?
Yeah, sure. We do a lot of structured research on the outcomes of our bond markets and how the returns will look based on different outcomes. We're not going to claim that we can forecast where the bond markets are going to be, but we do know mathematically where the index will see returns if various scenarios do play out. So if we just cut it down to 3 scenarios just to simplify things. Scenario 1 might be increased velocity of inflation. So we're going to have to keep hiking aggressively. Bond markets will continue to sell off. Let's say a 10-year treasury or a 10-year bond goes from 4% out to 5% over the next year. So if we were to see 100 basis points sell off in 10-year treasuries and 10-year Australian bonds, we expect this would hurt all risk markets. We'd expect cost of funding to continue to increase. We'd expect earnings of corporates to really get hit, and so it would be pretty bad news for risk assets. In that time, from a 4-year 4% bond yield, you're still picking up the income characteristic of the bond, so you get a bit of a cushion to any sell-off in actual bond price, in bond yield, over that time. So you'd expect in the order of a 2 to 3% drawdown in your bond portfolio, which we'd expect would outperform the rest of your portfolio and provide some sort of diversification. If markets stay as they are, and that's probably pricing in more of a soft landing, you're expecting to get a bond market return of about 4%, which is about what the current index is yielding. And in the case that we do start to see rate cuts, if the market and the economies do see slower growth and slower inflation and higher unemployment rates, then you can expect returns of in the order of 10%. So they're pretty healthy expectations and possibilities from here, with obviously not limited downside, but you do have a bias to a better outcome.
And so just touching on the RBA for a moment, we're actually sitting here on the first Tuesday morning of July, so I'm not going to hold you to a prediction on what the RBA is going to do later today, but maybe just some thoughts or comments on potential leadership changes at the RBA and how that might impact policy going forward.
Sure. Well, I think what we've seen and looking in from our point of view is that since the RBA review, Governor Lowe has put upon himself to really have a crack at the inflation targeting. And so, this time, only a few months ago, we were sitting at 3.6% cash rate. It seemed, following the meeting in earlier this year, that we're probably done at 3.6%. The quarterly inflation number came out at the end of March. before the April meeting, and they turned, and we saw a 7% print, and inflation was too high. The governor had to continue his hiking cycle. So he's put in another 2 since then. What we don't know going forward is if he will in fact be the governor from September onwards. There's a lot of political opposition to him sitting there, and there's a lot of talk in the press about whether he does survive or not. He wants to be there. My understanding is that the people that they are looking at, and none of it's been made official yet, they're all more on the dovish side. So it's going to be his legacy to want to most likely get on top of inflation before he does leave the seat, if in fact he is gone by the end of September.
So just pulling all those thoughts together, can you maybe just talk us through how you're sort of managing the portfolio through this environment? Obviously, volatility in bond markets is still quite elevated, but we do have quite a bit of yield now built across the curve. Are you sort of targeting specific trading ranges, or taking some bigger outright views at this point? How's your execution sort of looking?
Look, historically speaking, a cash rate, especially in the US, of 5% has been sufficiently restrictive to inflict some damage on the economy. As we've mentioned in a little chat now, we're not seeing inflation fall apart just yet. The core part of inflation, so rent and services, is still quite sticky. Unemployment is still in the mid-3s, which is too low for what they do want to see. But what we do know is the lagging effect of monetary policy means it will slow down in time. So we believe we're pretty close to the top of the hiking cycle. As we said, this time 12 months ago, markets were pricing in a US cash rate of 5 point something. Well, we've met that level 12 months on. Aussie was pricing 4 point something. We probably didn't believe at the time it could get there. It has, with maybe a little bit more to go. But what we do know, having with those levels priced in and delivered, markets are now pricing pretty much the peak in cash rates, and we're pretty confident that that is the level. And once we do see the peak in cash rates and the market's confident of that, we can see bond yields start to perform again. So what are we looking for? We're looking for confirmation of these the softening inflation, the softening of unemployment. We've already got the leading indicators. So, for example, the ANZ consumer confidence number was out this morning. That was the weakest number in 30 years outside of COVID. So people are really worried. People are cancelling holidays. People are buying less things. Although the latest retail sales was quite strong, a lot of it was in the food area, which means people still have to eat. So, but the discretionary spending is definitely starting to slow.
Great. Well, really appreciate your time and insights today, James. Fantastic update. Look forward to sitting down with you again later in the year. And thanks to everyone for tuning in. Any questions or further information required, please get in touch with us at Channel Capital.